Information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.
Hello and welcome to another week in property. I'm Margaret Lomas and you're watching Your Money, Your Call. The Queensland Government announced plans to scrap the $7,000 first homeowners grant and replace it with the $15,000 handout only available for those first home buyers buying a new home. It's less than the $17,000 available to first homeowners buying or building a new home under the previous Bligh government, who were eligible for the $7,000 first homeowners grant and the $10,000 building boost. The changes mirror a similar move by the New South Wales State Government in its June budget, which ends the $7,000 first homeowners grant on the 1st of October, replacing it with the $15,000 handout for those buying a new home, including homes bought off the plan. The REIQ expressed disappointment at the decision and warned that thousands of Queensland first property buyers might delay purchasing their first homes following the scrapping of the handout. Their analysis shows only 24% of first home buyers opted to buy a new home when the boost for new homes was available. They say that the main reason for this is that new homes are usually too expensive for first home buyers and often located in outlying suburbs where young people don't necessarily want to live. And according to BIS Shrapnel, immigration trends, vacancy rates, housing undersupply and employment prospects all favour Queensland and WA to lead the next phase of housing market growth over the next 2 to 3 years. But the stars aren't lining up in Victoria, with BIS economists tipping up to 4 years of pain and downturn for its economy and housing markets. They believe that the weakness we have seen in Melbourne so far is only just the beginning. Tonight I've asked two property experts to join me to discuss these stories and, as usual, answer any of your own questions. And so please welcome to the panel Ian Rodriguez and from Bishop Collins and Ben Kingsley from Empower Well. Now you can join our discussion or ask any question about property simply by calling us on 1300 30 34 35. Now if you'd rather put your thoughts down in writing, you can do that and send them to me in an email to property@skynews.com.au. So sit back, relax and enjoy tonight's program. And welcome to you both.
Thank you.
So, lots has seemed to have happened in my absence while I've been sunning myself overseas. Ian, Queensland is now following New South Wales into scrapping that first homeowners grant. And even though they're painting the good news story that they're now giving $15,000, it's not really that good news, is it?
No, I think the first homeowners grants, people have become accustomed to them. They've been around for a little while now, and at some point I suppose they've got to end. And I think the latest thing going on at the moment is that obviously Queensland and New South Wales, with new governments assessing where their budgets are, they're looking for everywhere. So I think the first homeowners grants are something they've got to tighten up or remove. I think there's going to be budget pain across the board in these states.
Ben, of course, you know, that it's all very well to say that the measure is designed to stimulate new building and more housing. But I don't know, I'm a little bit dubious about that, and I tend to think that builders always and developers always like to pop that little bit of profit in there, and most people who buy a brand new home, they usually pay more than the underlying true market value anyway, don't they?
There's no doubt that the 15.7 or 15 is irrelevant, isn't it? I mean, the most important thing that the government's trying to do is stimulate the flow-on effect. With construction comes consumer spending. You know, you've got to basically, you know, put all the furniture and appliances in the house, so that generates jobs. So that is the flow-on effect. So the government's basically saying is we're not quite confident on the economy, and this is the way in which we can get people into jobs, not just in the building sector, but across the whole sector. But the reality is you're not getting a bonus, and a lot of first home buyers think I'll just wait for the next stimulus package to roll through because they have become so accustomed to it. And the bottom line is, you know, there's no savings there, but hopefully if they do get into the market with interest rates coming down as well. It's not a bad time to start looking at it.
So you're saying it's actually a stimulus measure in disguise to look like a first homeowners grant, and homeowners across the board should just accept that there's no grant. And that this is really the first homeowners compensation for buying a property that's probably going to cost them more than it's worth anyway.
No doubt, it's penalising the people who are buying existing property. You know, we saw in that news article there that people don't necessarily want to move to the outer suburbs. They do like the lifestyle drivers that they're accustomed to or they've grown up with. So I think you'll see that that they're obviously feeling a little bit shortchanged. And as for the people who want to move out, you know, into the mortgage belt and start their dream, you know, those people will probably benefit from this exercise.
Ian, I should think that one of the good things to come out of this, and since this isn't the first homeowners show, it's actually the property investors show, I should think one of the good things to come out of this is going to be that it's going to remove some first homeowners from that lower end market, potentially the established market, and then leave the negotiation ability more open to property investors who may now be able to get a little bit of a bargain.
Yeah, I think the economics of this type of policy is a little bit sort of debated, I guess. There's different views on it. But if you trace it back, the history of these things go back to when GST started as some type of compensation. So I know empirically I've seen auctions where the investors have sat back and, you know, ended their bidding, and there's some happy first homeowners charging on that little bit higher. So, I mean, that's just empirical, but I'm sure there's some economists that say, you know, this was a vendor's boost, not a grant to the buyers. So I'll leave the economics, you know, to those guys. But there is some doubt about whether the policy really does work. I mean, you know, Ben's raised the point about the carry-on stimulus, and I think that's probably a valid point. But I sort of wonder whether it really has had the desired effect, and now that they're going to remove it, market prices will go back to true market with investors looking to buy.
Yeah, and I think from an investor's perspective, it's probably a good idea to wait just until after the 1st of October, Ben. And I'd suggest that other states may begin to follow suit as well. If we've got now 2 states jumping on that bandwagon, it's not going to be long before the rest jump on as well.
Well, we've seen in Victoria as an example, Margaret, where we're seeing, you know, the government down there's no further stimulus statewide, so we're just relying on the $7,000. And Victoria is one of those states that is starting to come off the highs of the property cycle that it enjoyed from 2007 right through to the recent times. So I think, you know, if you want to stimulate an economy that's outlook's looking quite dim, that is one way where you get the flow-on effect. You're not going to get the bargain that you think you're going to get, and you know, it's that mental perception that they've got $15,000 that's going towards the deposit, and that's probably more to the point of, you know, that when they look at their lending and what they're saving, that might get them off their seats to start doing their research. But I'm with you, Margaret. I think start your research now, but just wait and see how the market plays itself out.
So speaking of dim, unfortunately the state that you reside in has been getting a little bit of a, well, I mean, it's really been copping a lot lately. The last couple of months there's been a lot of doom and gloom, and now BIS Shrapnel, whose opinions many people do value, have come out and said that there's more to come in Victoria. And I should think that that's probably due or overdue, given that you did come out of those starting blocks after the GFC just like, you know, a rocket. You really were 2.5 pool lengths ahead of everybody else, and now everyone else is really just catching up.
Yeah, I think it's a really good point. There's a couple of points to make there, and I think that, you know, the Warren Buffett, be fearful when others are greedy and be greedy when others are fearful. I think we're starting to see the broader market and the macro climate down in Victoria starting to get the negativity through. What is interesting is the latest data out of RP data shows growth in the last month in the Melbourne market, and I think that is the message here. The message is, from a macro point of view, we are going to see some gloom and doom around the Victorian market, and I think there is argument for the broader market around the mortgage belt, and I think that the building boom that went on has delivered an oversupply in some of those new estate areas, and I think you want to be very careful about where you're putting your money in that particular market. Contradictory to that is that, you know, some of the clearance rates in some of the other areas of the market, we're seeing, take for example Kew and Hawthorn, those markets are actually delivering late 70s, early 80s in auction clearance rates. Now those are big numbers, and that's showing that there is some demand in certain markets. And I know in our business, as an example, we try to measure clearance rates by room type. by property style, because that's going to give us an indication of where the real underlying demand lives, because that's what we need. We need those demand drivers. Broadly speaking, yeah, Melbourne's off the boil, and I think there are other opportunities in other markets if you're looking broad. But if you do your research well, I still think you can cherry pick some really good opportunities.
Ian, Western Australia and Queensland, no surprises there.
Yeah.
Both very resource rich, many towns in those areas growing along the back of resources. Do you think investors do need to worry a little bit about that, given some of the doom and gloom surrounding resources at the moment?
Yeah, there's always plenty of comment about what's going on in the resource stakes. Like the discussion around resources, if you listen to the media, there's some type of end of a boom. But if you listen to the economists and senior economists within banks, there's a massive pipeline of expenditure still coming. And a lot of the projects that haven't been, where they've cut back a bit or they've put them back a bit, were never the top range of projects that are happening. So the concern for investors is a bit like the Melbourne story, I suppose. Have things got ahead of themselves? I mean, some of the prices that people are paying for some of these properties, is it a continued upward trend, or has it really overshot a bit? And maybe any little movement in the market's going to bring them back to earth. I'm a believer in markets, and I think those laws of supply and demand work. And markets will overshoot and then retract, but on a trend that's going to continue.
It's interesting, isn't it? Because I actually had a question through the week from a journalist writing for a magazine saying, the Olympic Dam project now seems to be in doubt. Have you reversed your views around whether or not you should invest in Adelaide? And of course my answer to her was, my views around whether you should invest in Adelaide had nothing to do with the Olympic Dam project in the first place. And to me, that wasn't the drivers that I was seeing in Adelaide over the coming couple of years. It was more of those things that you can rely on and depend on and that are sustainable, like a growing population and plenty of infrastructure development going on in the north and south there. Lots of things happening in terms of shortage of land, but lots of services going into areas, so there'll be a lot of demand for established housing.
Yeah, well, I think if you're going to rely on one driver to drive any investment, it's a highly risky strategy.
Absolutely.
So, the things that worry me about the mining towns and things like that, I guess, are, the element of what happens when, if mining and, moves to another town or just down the road, and what's left. And there's plenty of examples of the old gold rush towns that now are just sort of, a couple of sticks in the ground. So.
We have to remember those. So let's go to the phones and Paul from New South Wales. How can we help you tonight, Paul?
Yeah, hi. I suppose I'm looking for some advice. Myself, my fiancée and another couple are looking at possibly buying a block of land in our local area, and we're looking at subdividing it in about a 7-lot subdivision. This is the first time we've done anything like this, and I suppose just ring up to find out what you guys can suggest as advice and things we should steer clear of or whatever like that.
Okay, Paul, now you're buying a block of land. Is that purely for yourself to live in eventually and have a subdivision on it, or is it an investment only?
No, purely an investment only. There is actually an existing dwelling on the property that we might move into for 12 to 2 years, or 12 months to 2 years to save on repayments, but just purely as an investment, yeah.
Okay, and then ultimately you want to then subdivide it and build 2 dwellings, is that correct?
No, subdivide it and have 7 lots in total on the premises.
Okay, so you're just looking for some general advice, Paul?
Yeah, well, I've been doing some homework now, and there's a few easements on the block, which I'm assuming why most developers have sort of steered clear from it. That's why it's still on the market, which is a transmission easement and an E3 area, which is a little creek, and also some protected trees under an EEC, Endangered Ecological Community.
Yep.
So I think, like I said, that's why a lot of developers have sort of, steered clear of it. So, yeah.
Okay, now is this your first ever investment, Paul?
It's not actually. I've got just a townhouse as an investment property. This is my first subdivision investment, yeah.
Okay. All right, well, Ian, it sounds like Paul is about to bite off a pretty large chunk there.
And chew like hell.
Yes. So what's your advice for Paul?
Look, a couple of things, Paul, when you're looking at this. You mentioned you were going in jointly with some people. So obviously make sure you've got all the agreements in place and a good understanding about how you get into this, who's going to fund it, and how you get out of it. So before you go in any deal, you know, understand what that exit plan is, what if someone needs to be bought out, all those types of things. Beyond that, when you're looking at the numbers, be mindful of a couple of things that usually get forgotten often by property developers, particularly when they're not in the business of property developing. But GST is one. So you might say the land's for sale for a price, but remember, GST is going to be in there as well. So make sure your accountant's looked over the numbers and has allowed for GST, because taking 1/11th off the ultimate sale price can be a very big number, and can turn what looked very profitable into something not so profitable. And the other one is make sure you've got all the costs in there, and the biggest one that people tend to get very concerned about is Section 94 contributions. So I'm not sure where this is. It's maybe in New South Wales, but certainly they don't miss you on those. There's a lack of clarity in understanding how much they can be, so get some good advice around those two things.
And Ben, I guess my biggest concern here is that if it's been passed up by other developers due to all of these easements, then that could be for a good reason.
Look, there's a couple of warning signals in this one, Margaret. For me, the first one is, you know, you want to understand what sort of skill level you bring to the table. If this is something that you're not confident with or have experience in, your knowledge, your experience level, and understand your return on investment. A lot of people think that this is an investment. It's not. It's actually a second job. You're actually trying to harvest some equity out of cutting up or slicing and dicing a block. In my business, I see, you know, quite a few people coming in and talking about the return on investment. It needs to be quite high because the risks are also quite high, whereas you could have a more conservative investment strategy and still get a long-term outcome along this point. Obviously, you've done a bit of reading, Paul, which is great, so you've talked about the easements and the EEC. They're all important things to consider, but for me it is about understanding the long-term aspect of what you're about to do. Ensure that it is subdividable. There's nothing worse than making a commitment on a purchase without knowing the end goal and if that end goal is actually going to materialise. I mean, for me, starting out, this is a make or break investment, and I'd just be saying do your homework, because, you know, I'm cautious of it in the first instance, and that's what I'd be saying to you, Paul.
And Paul, look, I just want to add, and certainly our job here is not to discourage you from something that could end up being a good investment for you. More so, it's to just make sure that you do have all of those T's crossed and the I's dotted, and you don't get into something that you actually can't chew like mad, and we don't want you to bite off more than you can chew. Paul, I find when people get into an investment with other people, be they friends or siblings or relatives of some description, very often people don't have exactly the same time frame in mind, and they can come to grief. Now further, if you need to borrow for this investment and you're borrowing as a joint entity, just bear in mind that if you want to go on and then invest in more property on your own, the entire loan will be considered yours for servicing purposes. So the new bank, when you're going for more money to invest in something on your own, will consider that entire debt as serviceability for you, just in case all of the other people in it ran away. So it could hamper your ability to do anything else while you've got that debt on that property. As Ian says, make sure that you get your agreements nice and tight, and make sure that it's all in writing. Handshake deals never work, and often all they end up in is in loss of friends, and you don't want that to happen at the end of this development. You want to make some money, but you want to have your friends as well at the end of it. Good luck with that, Paul. Well, if you watch every week, you'll know that the panel and I pick one question either from the calls or the email to receive a copy of one of my books. This week, the chosen email will receive my latest book, Investing in the Right Property Now. This book is all about the current economic situation and explains how you can use knowledge of economics to forecast property hotspots. All you have to do is call or email with a question, and make sure that you watch at the end of the show to see if you're the lucky person. Now, you can do that by phoning us on 1300 30 34 35 or emailing property@skynews.com.au. It's time now for a short break, but stay with us. After the break, we'll be taking more calls, answering email, and helping you to navigate the waters of property investing. Welcome back. You're watching Your Money, Your Call, and this is a show which aims to help property investors make sense of all that information which is out there. Tonight I've asked Ian Rodriguez from Bishop Collins and Ben Kingsley from Empower Wealth to help me do just that. So give us a call right now. The number is 1300 30 34 35. You can also email us on property@skynews.com.au. Now, before I go to the next question, just a quick reminder about my seminar, which is tomorrow night, Tuesday the 18th of September in Adelaide. The seminar is your chance to find out how to invest well and to hear my take on where property is headed. And I'll also be providing my 2012-2013 hotspots. Now, if you're about to start or improve your own property portfolio, you simply can't miss it. Go to my website, destiny.com.au, and visit the events page for all the details and also for tickets. And Richard from New South Wales, welcome to the program tonight.
Thanks, Margaret. I was watching the program last week, and there was a caller who called about buying property in England, and you said if the market did move down or the Australian dollar moved down, he would be losing. Well, in fact, the contrary, if the Australian dollar did move down and you purchased with a high Australian dollar now, you would be making quite a lot of money. If the dollar moved up, then of course you would be losing. I personally did that in Hong Kong in 1984, when one Australian dollar bought $7.25, sold 10 years later when it was $4.50. Big tip, buy during recessions. Thank you.
Yes, and Richard is correct, although I think what we did say last week was if there was movement in the Australian dollar, there was a foreign currency exchange risk to be added to the risk of investing. And that applies to whatever way the pound, the dollar, the yen moves. That always introduces a foreign currency risk to investing in property. And, you know, I guess you gentlemen would agree that it's already risky enough investing in property overseas without then having to factor in the movement in what is currently becoming a fairly volatile currency, Ian.
Yeah, I gather that, like, trying to pick where the exchange rate's going to be, we've got the experts who seem to change their mind and their view, and you can't predict it that far ahead, and then it only takes sort of, you know, the US printing some more money in it, and suddenly it's gone up. Everyone sort of says yay, but I'm not sure that it is a yay. It's as an overall sense. But yeah, if you're going to invest overseas, I mean, people got burned many years ago, and it's funny how people forget, but borrowing overseas and not allowing for hedging, you know, currency movements. Now, I was a whippersnapper when this happened, but it was a long time ago, not that long. But yeah, that's exactly it. People forget these things and seem to learn the same lessons again. So it's
and of course,
frustrating.
Ben, it's hard enough to invest in property here in Australia. You do have to know an awful lot about the market, about the property, about the area. That's very difficult to get that right kind of information in a foreign market.
Look, it is, Margaret. Unless you know something about that market, I would be advising people to steer clear from any markets that they don't have an understanding of. So I'll take, for example, I had a carpenter who recently helped renovate my home, and he was Irish, so obviously Ireland's had a big downturn in the marketplace. Now, he actually did sell a property in Melbourne and looked to invest into the Irish market. Now, he knew the market. He had family over there. They'd studied the values of those markets, and they went over there with the right framework, the right research, and they've executed on that particular purchase. Now, I have no issue with that, but where I take issue is in people thinking there's a quick buck to be made in whatever market around the world, whether it be, I was in Phuket recently, and, you know, there's a property boom going on in Phuket, and a lot of people just think that this is easy, and because, you know, you just ride the wave. Well, it's not that easy, and currency is only one part of the equation. There's obviously political risk, there's legislation risk, there's all these different types of factors that are out of the control of investors investing from Australia in these foreign markets. So I'm always cautious. I'm a cautious advisor, let alone cautious investor. And so, Richard, you're right. You know, if the currency was to die but you were getting paid in English pounds, absolutely correct. You're going to be making a return on that percentage. But ultimately, I'd still say buyer beware, do your research. And if you don't understand the market, don't invest.
And of course, you know, property's being sold to you by a middleman who's come down to Australia to sell property. You've got to ask yourself the question, why won't the locals buy the property? What is sending those people so far down under to try to sell us property in other countries? They'll give you some good reasons for that, but in reality, it's because the locals know something that we obviously don't know. Colin from New South Wales, how can we help you?
Over in the panel, how are you?
Good, thank you.
That's good. Look, I've been watching your show religiously over the past few months, and it's got me really keen into learning more about property investment.
Excellent.
I recently paid off my principal place of residence, so I've got a bit of money away to invest. But before I sort of bite the bullet and sort of start investing, I want to learn more about the basics, and I was sort of wondering if you could recommend some books or some other resources that might explain more about property investment for somebody like me just starting out.
Well, look, it's great that Colin has called in and asked about getting educated before he goes out and does something. I'm sure that you'll both agree that whenever you meet a property investor who has a failed property investment, it's more than likely because they didn't become educated first. They took a tip from the butcher, they were on holidays and decided to invest in a great, unit that they were living in, that they used all of the wrong reasons for investing and they did not become educated first. Ben, what's your advice for Colin?
Look, Colin, the fundamentals of any type of investing can be learnt and they can be researched through good books. Obviously, Margaret's got a series of excellent books that have been out in the marketplace for a long period of time. There's books from Jan Summers, which are also good reads. And one of the biggest books I read when I was 16 was Noel Whittaker's Money Made Simple, or Making Money Made Simple, I think it was called, and that's obviously had some revised editions as well. I mean, understanding the concept of leverage, understanding the concept of capital growth, and understanding compounding interest, all of those are the fundamentals. When it comes to property, some of the things I always like to educate my clients are the fundamentals, the supply, the demand. If you don't have jobs, you don't have income. If you don't have income, you don't have borrowing power, which will actually push the values of property up. So you've got to be buying in areas where there's a propensity for income to grow. And there's also this lifestyle test that I always try and engage people to understand. If people only go to a location just because there's a job opportunity, but if that job opportunity was to dry up, then ultimately that area is going to fail. And they're called ghost towns. And they happen during gold rushes and they happen during mining booms. And so places that have been around for the longer period of time where they've got multiple industries, they're the types of things I'll be looking for and researching. And I'm a big fan of, obviously, ABS data to back that up.
Absolutely. Ian, what can you add?
I'd certainly just, in terms of anything, education is absolutely critical, and Colin's on the right track. Think about it, the old rule of measure twice and cut once, but the statistics around property investment are quite interesting. I don't know the numbers off the top of my head, but I know that the vast majority of property investors only have one investment property and they never really get beyond sort of going to the second or the third or really making a true investment of it.
I think it's something ridiculous, like 96% or something like that. It's huge.
78 for one, I know, because we've actually got a report on our website.
Okay, there you go.
Yeah, 78
and then
for one.
from 2 it dives dramatically, and I think 4% have 3+ or something like that.
Less than 1% have 4 or more. That's right.
It would seem to me there's an awful lot of people, obviously then in the market who've started, had to try it one, and then for whatever reason aren't able to go to the next one or don't do it. So, investing, like anything, is a risk, and having a plan and having a program to do it is pretty key.
Colin, 3 basics as far as I'm concerned. Books are a good way to start. Of course, I'm going to plug mine. I think they're pretty good. How to Create an Income for Life is the first one to start with. But by all means, I'm not the only writer. But what I do warn you against is this. These days, anyone can get a book published, and many of them look really legitimate, and very often they're just pushing their own barrow and their own business. So be careful that you're getting a legitimate book that really does educate you. Education is the second thing. You need to go to a good property education course. There's plenty of them out there. My company offers that kind of thing. I know that Ben's company also does education too, because we're firm believers that education is the key. The last thing that you have to do is seek out a support company, and you need to ensure that you get one that are members of the Property Investment Professionals of Australia, and that your advisor is a qualified property investment advisor. Everybody else are people who have just decided that they'd like to become property investment advisors, and they don't necessarily have the backing, the education or the expertise to help you. Now, if you want to know more about getting a good quality advisor, certainly my company Destiny is one, so is Ben's company, and if you go to pip.asn.au, you can have a look at all of our members, and they're the kinds of people who can certainly help you with your journey. You're watching Your Money, Your Call, and we're getting some great questions. Now keep them coming. We don't mind what they're about, as long as they're about property. For now, though, it's time to take a short break. But we'll be back soon, and if you have a question for anyone on the panel this evening, remember, the question of the week will receive my latest book, Investing in the Right Property Now. To be in the running, just call us on 1300 30 34 35 or send me an email at property@skynews.com.au. Welcome back to the show. You're watching the property edition of Your Money, Your Call, and we've been taking calls and having a lot of fun during the break about investing in property. Tonight you'll be speaking with Ian Rodriguez from Bishop Collins and Ben Kingsley from Empower Wealth, and of course I can also answer any property investing question that you might have. So call us right now on 1300 30 34 35, or you can email us at property@skynews.com.au. And Lou from New South Wales, welcome to the program.
Thank you for taking my call.
You're welcome. What can we do for you, Lou?
I've got a taxation question for Ian.
Excellent.
Ian, if I have an investment property, am I able to rent it to a son or daughter at market rate and still claim the deductions? And at the same time, if my son or daughter owned a property, an investment property next door, could I rent it? And they would then claim the deductions. Would I be doing anything wrong?
Oh, it just sounds sneaky. Swapping properties.
Yeah.
So, and paying each other rent so they could get deductions.
Well, I'll answer the first part of the question because that part's pretty easy. So you can rent an investment property to relatives or associates, as Lou mentioned, so long as it's at market value. So if you've got an agent opinion that says what market rent is, as long as that's what you're deriving. If you're renting it out at less than market value, the taxman can apportion your deduction, so not give you a full claim. So that's the way it works. The next part, Lou, where you said there's a property next door and you're going to rent it back from each other, there's nothing really in the Tax Act that says that you can't do that. I mean, both are at market value. As to why you do that, I mean, there may be a whole bunch of reasons why you may want to rent each other's property. You may not like the one you own, or there may be other reasons. Really, the taxman would have to try and say that, you know, the only reason you did this was for a tax benefit, to try and say there's some foul play. So, you know, if the only reason isn't trying to obtain a tax benefit, then I don't see a reason why you couldn't do that. But it does sound a little bit, you know, the last thing we give about any tax advice is what I term the sniff test. So if it stinks, it's probably not a good thing.
I love the sniff test, Lou. You know, Lou, I'm actually struggling a little to work out what the reasons for it would be other than to obtain a tax benefit. And the tax woman says that, you know, if the dominant purpose is for a tax benefit, it doesn't matter what the secondary purposes are, you just can't do it. And I would suggest in this case that you're going to be hard pushed to prove that you prefer your son's property and he prefers yours, and you'd probably be even hard pushed to prove that you're not actually sneakily sleeping in your own house while he's sleeping in his own house too. To me, it's a little too close for comfort, and I wouldn't like to tell you that the tax office would say yay or nay to it. There probably isn't a tax ruling on it anywhere. The best thing you can do, Lou, is to obtain a private ruling of your own. If you get that private ruling and they say that it's okay, then go ahead and do it. Ian, a private ruling?
I think, you know, Lou could go ahead and get something like that, but, you know, to be clear, I mean, the only reason I'd say it may well be legitimate, it may be that there's a one-bedroom, you know, bedsit on one side and a four-bedroom house that's more suitable, you know.
Yeah.
You might have a young family, but, yeah, if they're identical properties and this is purely about trying to be a bit clever, I'm with Margaret, I think you might have a few issues there.
Yeah, I think it's, you know, I think... I don't know you, Lou. I reckon you're a nice guy, but I'd say that you're probably trying to come up with a good tax benefit, and it's every taxpayer's right to minimise tax in legal ways, but doesn't sound like a great one to me. So just check that one out and maybe get a private ruling as well. Rowan from Victoria, what's your question for us tonight?
Good evening, Margaret and panel. Like a previous caller, I've been following you and the market closely, doing a fair bit of research over the last 6 months. A few people have recommended staying closer to home for my property investment, which I'm going to make soon, but understanding that there's been some challenges with the Melbourne market, looking outside of Melbourne, regional areas, the Ballarats, the Geelongs, Milduras, these sorts of things, what do you guys have an opinion in regard to these areas in the Victorian market?
You Victorian people are very patriotic, aren't you? You like to live there and then you have to invest there as well. What's wrong with the rest of the country, Rowan?
No, that's a fair point. It's my first, and I know you're very strong about looking broader, but it's just going to, put the toe in the water and stay close.
Okay, Rowan, in a couple of weeks I'm down for the Home Buyer Show. You need to go online, get a free ticket from my website, destiny.com.au. Come along and I'll deal with you at the Home Buyer Show, okay? Okay, he's not answering that. I've scared him off already. Ben?
Don't go anywhere, Rowan. Obviously, I'm a Victorian and patriotic just like you. And look, our business, I've got to disclose, is yes, we are active in the Ballarat market and active in the Geelong market. We are buying properties through our buyers agency side of our business as part of the investment strategies we're putting together for our clients in those particular markets. Now, why do we like Ballarat and Geelong as an example? Mildura is another conversation, but we do like the fact that they are close to a major employment centre. So they're insular in the sense that they obviously have multiple industries. The townships have been around for 150 plus years, since obviously the gold rushes and so forth. So we're seeing a township that's got great infrastructure, it's got medical facilities, good schooling. So we're actually seeing people making a transition, a lifestyle transition around working in the major centre of Melbourne and then basically making their dollar stretch further by going out and buying a bigger home and giving their children the best of chances in terms of the education they want to give them. So we're actually, still bullish on the Ballarat market. We've been buying in that market now for around 9 months, and we're also buying in the Geelong market. And the demand for rental accommodation in those markets is still very strong. So that's the reason why we're playing in those markets at the moment.
Ian, let's pretend for a moment that Rowan said he didn't care where he invested and that he's not staying patriotic to Victoria. Have you got any other suggestions for Rowan?
Yeah, look, the only one's a little bit... I won't try and pick where you should invest. I'll leave that to others, Rowan. But we were talking about the number of property investors earlier that only ever buy one property, and that's as far as they get. From what I've read too, if you draw where you live and sort of draw a 5k radius around that, most of those property investors are buying very close to home as well, and reasons of just it's something they know rather than where is a great investment. So if you're going to get serious about property investment, I'd be saying, look, it's a big country out there, look much further afield and probably eliminate that 5k radius because maybe it isn't the right place to invest. So.
You know, Rowan, I once had someone ask me or tell me that they wouldn't be able to buy away from where they live because they don't know any other areas and they know the area where they live. And when I questioned that person about what they truly knew about their own area, they knew a lot, but none of it had anything to do with the investing potential of the area. So people are often lulled into a false sense of security by believing that they know an area where they live when they don't actually know what they need to know about whether or not it's a good investment. Someone also once asked me how it is that I can consistently go and invest in areas that I don't know. And the answer to that question is I never invest in an area that I don't know. I often invest in areas that I've never heard of before. But by the time I invest in them, I know more than the locals know about that area because I use the 20 questions and use a very specific process of research to determine everything I need to know that has investing importance to me. And that's how you invest outside of your own state, and that's how you do so comfortably. Trust me, it works. And the most important thing for you to do is to first of all work out your time to retirement, your needs in terms of cash flow and growth, and the kinds of property that you can afford, or the price of property you can afford, and then start to find the very best area in the country to buy it in. This is your first investment property, so the first one has to be fantastic. You can't afford to stick to an area simply because you're frightened when it might mean that you're not going to be investing in the best area that there is in the country. I'm certainly not saying that about Ballarat or Geelong, both of which I do like. I'm just suggesting that for this and all of your other investments, you do need to get comfortable with being able to go to the very best place to invest, not necessarily the one in the state where you live. Well, this week we have an email from Dallas who's trying to work out the best way forward for their own investing. And she writes, my partner has a 3-bed villa which is rented out. Now he wants to sell it and pay off some of our home to become mortgage free faster. His property is worth $300,000 and it has a mortgage of $160,000. The car and house we live in has a mortgage of $300,000 and it's worth $500,000. Should we consider remortgaging his villa for another investment or sell it? We both have well-paid jobs. Ian?
Well, it's very tempting. I mean, the idea there that you could take the equity out of that property and pay down the home loan is very tempting. From a tax point of view, clearly you've got a mortgage there that is not tax deductible, the $300,000, and of course the property that's worth $300,000 with a loan of $160,000 is probably likely to be making a tax profit. If you're both on good incomes, you're probably paying some tax on that. So I think you really need to crunch the numbers on this one. We don't have enough numbers to really say, but the big thing to watch out is what you would get for the villa after all the costs. And of course one of the big things to allow for is capital gains tax. So if it's a villa, there's a good chance you've been claiming construction allowance, and a lot of those things get clawed back when you do sell the property. So I'd be very mindful of understanding what the capital gains tax is going to be before making a final decision. Of course, investment issues aside, you know, this villa might be a great place to stay, and what are you going to replace it with? So there's a lot to think about.
Ben, just quickly, what?
Yeah, look, really quickly, Margaret, we need to assess whether this villa is actually investment grade. Why would you flip an asset when it's, looking at the numbers roughly, it's going to be cash flow positive as it stands? So you could potentially be getting that extra income and paying off your mortgage just as quick, but also controlling 2 greater assets. So there's a lot to be said for this, and my simple message to Dallas is get some advice. Get someone to assess that first villa, to assess your cash flows and put a strategy for you. So go and speak to a qualified property investment advisor.
Yes, absolutely. And Dallas, I've got one other little sort of spanner to throw in the works there. I'm thinking that it might even be possible that your partner's villa is one that he previously lived in. Now, if that's the case and he's since moved out of there, he could be still within that 6-year period where it's capital gains tax free. And if that's the case, and you've also ascertained that the villa doesn't currently exist in a hotspot, you can easily do that by just asking the 20 questions about that villa as if you were going to buy it all over again. Would you buy it if it was offered for sale to you this time around? But if the answer is no, there's probably a better area to invest in, and it's also in that 6-year capital gains tax free allowance period where you can move out of your own principal place of residence and have up to 6 years to sell or move back in. Might be worth it to take advantage of that capital gains tax free period, sell it, take the money, pay off your own home, and then leverage back from your own home immediately, because remember, you'll create equity there to buy yourself another investment in a hotspot. Get some good advice, as Ben said, but there's a couple of things for you to think about. Thanks for all of your questions so far. It's time again for another short break, but we'll be back really soon. Remember, you could receive my book, Investing in the Right Property Now, just by asking a question and then being the caller chosen by the panel as the question of the week. To be in the running, call us now on 1300 30 34 35, or if you'd rather write it down, you can do so and email it to us at property@skynews.com.au. Welcome back to Your Money, Your Call. I'm Margaret Lomas, and tonight I've had the pleasure of the company of Ian Rodriguez from Bishop Collins and Ben Kingsley from Empower Wealth, who are doing a great job answering your questions. Now, we've got a few minutes left, so now's the time to call with any question. Now, you might be able to receive the book of the week. The number is 1300 30 34 35, or you can email us on property@skynews.com.au. And Marco from Victoria, welcome to the program.
Hi, how are you going?
Good. What can we do for you, Marco?
I just want to know what you think would be the best place to buy a house and land in the inner city of Melbourne, 3K radius around the city.
Oh, why is it that you're after a house and land in a 3K radius, Marco?
Because I just love living close to the city. I think the city has so much to offer. They have the markets, they have It's easy to get to work. I work in the city, so I live in the suburbs now, and I hate the infrastructure. I just think it's impossible to get to the train station. I think it's impossible to get to the city, so that's why I just want to live close to the city.
Okay, so obviously an owner-occupied property here, Ben. So if you're an owner-occupier, where are you going to live?
What's my budget, Marco?
Say around $1 million.
Oh, well, $1 million is in the Melbourne metropolitan area is going to get you close to 3 kilometres. You're sort of going to be maybe on the eastern side more like sort of 3 to 5 kilometres. If we're talking about, you could probably get a semi-detached in the sort of more tightly held areas of Port Melbourne and that sort of Bayside area. If you're going over to the west, you can get a fabulous home very close to town in the Yarraville, Seddon area. That's sort of right at the top end, but you'll basically have a beautiful home in that area. And then if we push into the northern suburbs, you're probably talking about a really classy home in the areas of, say, Preston, and pushing back into sort of more, sort of the areas around Clifton Hill and Fitzroy, Carlton, but they're going to be smaller dwellings in that area. And the eastern suburbs, again, you're pushing out, if you're looking for a more sizable home, you're sort of looking around the areas of probably Richmond at sort of mid to entry level and around into sort of the corridors of Elwood and that type of thing. But the closer you move to the beach, the more expensive it gets.
That's very true. Marco, what I would like to say to you is this. When we look at buying a property to live in, and I'm assuming the reason you called us is not to find out what the price ranges are, because that's pretty freely available on the internet, but to find out which area is going to give you the best investment potential. But when we buy a property to live in, really investment considerations must come secondary to those lifestyle needs that we have. So there's a couple of things that you need to look at that you wouldn't look at if you were buying this as an investment, and that is, who are your neighbours going to be, and does that kind of social network suit you? It could be an area that's got families, or it could be an area that's got young singles. Who are you, and which kind of a social network do you want to fit into? What kind of public transport is available there? Because I find when people do live that close to a city, generally they don't worry about their car so much, and they take advantage of the trams and the networks that are available there. And can you get the style of home that you're really going to like? Particularly in Melbourne, there's some very unique different styles of homes in different suburbs in and around Melbourne Central itself, and you need to work out whether they're a style of home that you're really going to like having. So that's all very important to you as an owner-occupier, but not so important to you as an investor. As an investor, you need to know what the rental yield is going to be and whether or not there's infrastructure planning and a whole pile of other things as well. I'd venture to say that you're probably trying to look at the investment potential, but that might just lead you into buying in an area that doesn't quite suit you personally. I'd recommend that you just go with your heart on this one rather than with your head. Well, our second email this week relates to self-managed super funds and comes from Ian, who asks, we're looking at buying an investment property with a self-managed super fund. My wife's super has $130,000 in it and is not performing well. We have a financial advisor helping us set up the fund. Do you think this is a good strategy? We're looking at a property of $400,000 to $500,000. Where and what type of property would you recommend? How do we check out our financial advisor? We don't have a lot of time left here, so I'm going to go with you first, Ian. Self-managed super.
Yeah, so the strategy you're talking about is obviously taking your money out of wherever it is that isn't performing well. And again, I think most people's super is not performing particularly well with the way things are being. But the decision to set up a self-managed fund is a pretty big decision. There are costs, there are benefits, and it's not for everyone. Having said that, there are around about 480,000 of them in the country, and it's the fastest growing sector of super. The next part you're talking about is obtaining borrowings within super to buy the property. And again, that's a new level of risk, a new level of investment strategy. You really do need to get great advice around this. It is certainly not for every investor, but there are plenty of people that are getting the right advice and are getting on with it.
So how do you choose a good advisor then, Ben?
It's a great question, Margaret, and the most important thing when you're looking at financial advice regarding property, there's a big perception or misperception out in the marketplace that financial planners are good property investment advisors. If you're going to a financial planner to get property investment advice, ask what sort of education or qualification do they have around giving property investment advice. you may find that most financial planners out in the marketplace don't actually have education or qualifications around property advice. What they do have is education around investment products such as shares, bonds, managed investment schemes, etc. So my biggest tip here for you, Ian, is to ensure that you seek out the service of someone who's educated or has a qualification to give you advice as to whether this is the right thing to do, because asset selection is critical.
And of course the last part of the question comes down to me, where should you buy? That's the easy part, because you should buy wherever the research takes you. Like any investment, that asset selection, as Ben says, is important, and you must do the research so that you're choosing the right asset once you've decided that it's going to be property. In terms of whether or not it should be property for your super fund, just remember, if there's only $130,000 in the fund, then that's only going to allow you to buy one single property, which means all of the fund's assets will be invested into the one single thing, which will be that property. If the property doesn't go so well, then all of the fund's assets are at risk, just as they are now when they're with somebody else. As everybody agrees on this panel, this is one for the experts. Make sure you get the right kind of advice, and not from someone trying to set up the fund for you, who's the person liable to make a fair amount of money from doing so. That brings us to the end of another great show. I'll be back again next Monday, and joining me then will be Brian Haratzis from Macro Plan and Rich Harvey from Property Buyer. Thank you to our guest Ian Rodriguez from Bishop Collins and Ben Kingsley from Empower Wealth, who will of course join me again in a few months' time. Now, our question of the week this week came from Colin from New South Wales. Colin, you called and asked about what books to read. Well, I figured what I should do is send you a copy of my latest book, which is called Investing in the Right Property Now. All you've got to do now is email me your address to yourmoneyyourcall@destiny.com.au. That's yourmoneyyourcall@destiny.com.au. If you missed out, you can get all of my books at any good bookstore or from my online store at destiny.com.au. And don't forget my Adelaide seminar tomorrow night, 18 September. Details on my website. And lastly, don't miss Property Success this Saturday, starting at 9 a.m. and then repeating every 2 hours or so all day this week. Now, we're going to be doing a roundup this weekend of our home viewer investors. Now, just before I go, I have 6 double passes to give away to my seminar tomorrow night. If you're in Adelaide and you absolutely are sure that you can be there, send me an email to the address on your screen, which is yourmoneyyourcall@destiny.com.au. There it is. Send me an email now, and the first 6 emails will get those free passes. I'm Margaret Lomas. Thanks for being with me. I'll see you again next Monday.
The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.